If you're planning to buy your first home in 2026, understanding your borrowing capacity is one of the most important things. So what actually is borrowing capacity? Borrowing capacity is the maximum amount a bank is willing to lend you based on your financial situation. It's not how much you want to borrow, that's not always how much you think you can afford, it's simply the lender's assessment of risk. They're asking one main question: if we lend this person money, can they comfortably repay it under stressed conditions? Your borrowing capacity determines your price range, what suburbs you can look in, and in many cases, whether you can buy at all. Two people on the same income can have completely different borrowing capacities depending on their financial situation. And this is where a lot of buyers can get caught out. By the way, I'm Nick, I'm a mortgage broker with Kingfisher Finance Group, and I specialize in helping first-time buyers and investors get into the property market and structure their loans in a way that actually supports their long-term goals. Now, why is borrowing capacity so important right now? Property prices have increased significantly over the past few years, and while growth has slowed in some areas, the reality is that prices are still very high compared to incomes. At the same time, we've had higher interest rates, tighter lending policies, and stricter serviceability buffers. What that means is that even if you earn a solid income, your borrowing power today might be a lot lower than you expect. I see this all the time. Buyers assume they can borrow a certain amount of money based on what their friends did a few years ago or what an online calculator told them, and then they're shocked when the actual numbers come back much lower. This is exactly why borrowing capacity matters more than ever. More people are being priced out of the market, and not because they can't save a deposit, but because the banks won't lend them enough to buy where they want to live. Understanding how borrowing capacity works and how to improve it can be the difference between buying now or waiting years. So let's talk about how borrowing capacity is actually calculated. At a high level, lenders look at three main things: your income, your expenses, and your existing liabilities. But it goes much deeper than that. Starting with income. Banks don't just look at your salary and call it a day. They assess how stable and reliable your income is. Full-time PAYG income is generally treated most favorably. If you earn bonuses, commissions, overtime, or allowances, lenders usually only take a percentage of that income, and often only if you've received it consistently for at least 6 to 12 months. If you're self-employed, income assessment can become even more complex. Lenders typically look at your last 2 years of financials, sometimes averaging the income and sometimes using that lower year. This can significantly reduce your borrowing capacity if your income fluctuates or has recently increased. However, being self-employed also has some big advantages because your income can be evidenced in so many different ways depending on the lender and the policy, giving you much more flexibility compared to if you were just a standard PAYG employee. Next is expenses, and this is a big one. Banks don't just rely on what you say you spend, they look at your actual living expenses, your bank statements, and benchmark figures like the household expenditure measure. If your declared expenses are lower than their benchmark, the bank will usually use the higher number. These expenses include things like groceries, transport, insurance, subscriptions, childcare, and lifestyle spending. Even small recurring expenses can add up and reduce borrowing power more than people realize. Then we have liabilities. This includes credit cards, personal loans, car loans, HEX debt, buy now, pay later facilities such as Afterpay, and any existing mortgages. On top of all this, banks apply a serviceability buffer. This means that they assess your loan repayments at an interest rate higher than the actual interest rate you'll be paying. The idea is to make sure you could still afford repayments if rates rise in the future. Even if rates come down, these buffers are still in place and have a big impact on how much you can borrow. So when you put all of this together, borrowing capacity isn't a simple calculation. It's a risk assessment, and small changes in income structure, expenses, or liabilities can lead to big differences in outcomes. This is why understanding borrowing capacity early is so important, especially as a first home buyer. Before you fall in love with a property, before you start attending open homes, and definitely before you make an offer, you need to know your real numbers. Now we'll go over what you've been waiting for. Let's discuss what you can do to improve your borrowing capacity. These are 5 realistic ways first home buyers can increase their borrowing capacity. Some of these are obvious, some of these are overlooked, and not all of them will apply to everyone. But even small changes here can have a big impact on the final number. The first one is increasing your income. I know this answer can feel obvious, and for some people it's frustrating to hear, but income is often the single biggest factor on how much you can borrow. The higher and more reliable your income is, the more confident a bank feels about lending to you. Increasing your income doesn't always mean something extreme. It could be picking up a second job, asking for a pay rise, changing employers for a higher salary, or upskilling so you can move into a higher paying role. Sometimes even a small increase can make a noticeable difference to your borrowing capacity. Employment type also matters. If you're employed casually and have the opportunity to move into a permanent part-time or full-time employment at a similar pay, that can improve how a lender views your application. Stable income is assessed more favorably, even if the dollar amount stays the same. I know not everyone has the ability to do this, and that's okay, but for those who do have the opportunity and are willing to make a change, improving your income can move the needle more than almost anything else. The second tip is reducing your spending. Again, this sounds obvious, but it's incredibly important. The way banks calculate your ability to repay a loan is essentially your income minus your living expenses. The bigger that surplus is, the more comfortable the bank is in lending to you. Lenders don't just take your word for what you spend. They look at your bank statements and compare your spending to benchmark figures. If you can demonstrate disciplined and consistent spending, it can improve your borrowing capacity. This doesn't mean you need to live off 2-minute noodles, but tightening things up for a few months and cutting unnecessary subscriptions and being mindful of discretionary spending can make a real difference when your loan is assessed. The third tip is reducing liabilities. As part of the assessment, banks look closely at your existing debts. This includes personal loans, car loans, HEX debt, and credit cards. Each of these reduces your borrowing capacity in their own way. The one I really want to focus on here is credit cards. Credit cards are one of the biggest killers of borrowing capacity, even if you don't owe anything on them. Banks assess credit cards based on the limit, not the balance. As a general rule of thumb, a credit card can reduce your borrowing capacity by around 5 times its limit. So if you have a credit card with a $10,000 limit, that could be reducing your borrowing capacity by roughly $50,000. If you rarely use your credit card, or you could live without it, reducing the limit or closing it altogether can be one of the fastest ways to squeeze out some extra borrowing power. The fourth strategy is buying the property as an investment property. When you buy an investment property, lenders can include the expected rental income in their assessment. So if you're looking at a property that could rent for $700 per week, that income gets added on top of your existing income, which can significantly boost your borrowing capacity. On top of that, lenders may also factor in negative gearing benefits, which further improves the numbers. For people living at home with parents and paying minimal rent or board, buying an investment property rather than a home to live in will almost always result in a much higher borrowing capacity. And there's nothing stopping you from moving into the property in the future as long as you're confident that you can afford the repayments without relying on the rental income. It is important to note though, if you buy your first property as an investment, you won't be eligible for first home buyer benefits. And depending on what you do with the property long term, there may be capital gains tax to consider when you sell. The fifth and final tip is using a mortgage broker. A lot of people go to one bank, get told how much they can borrow, and assume that result will be the same everywhere. In reality, every lender has different policies and assesses borrowing capacity differently. I've seen situations where a client's borrowing capacity varies by hundreds of thousands of dollars depending on the lender they use. And with so many banks and lenders in the market, it can be almost impossible to work out who is best for you on your own. This is where a mortgage broker can make a huge difference. Sometimes you don't need to change your income or cut spending at all. You just need to be assessed by the right lender for your situation. To finish off, I want to touch on a really important question I get all the time, and that is, should you actually borrow up to your limit? As mentioned earlier, when banks assess your loan, they don't base it on today's interest rate alone. Most lenders are required to include a buffer of around 3% on top of the actual rate. So if you're applying for a loan at say 5.5%, the bank's checking whether you can still afford the repayments at around 8.5%. That means the number you're approved for already includes a pretty significant safety margin. Now, I'm not encouraging you to maximize the amount of debt you take on. How much you borrow should always come down to your personal comfort level. It depends on how much debt you're comfortable carrying and how much of a monthly repayment you're genuinely happy to live with. What I do want you to understand though, is that if you do choose to stretch closer to your borrowing capacity limit, the bank has already built in room for higher interest rates. In most cases, you should still have surplus cash flow that can be used for extra repayments, savings, or building a buffer. And you should still be able to afford the loan if rates were to increase from where they are today. The key is making an informed decision, not an emotional one, and knowing your numbers before you commit. If you're a first home buyer and want to understand your borrowing capacity properly, or want help putting a plan together to increase it, I'm more than happy to help. You can book a free chat using the link down below, and we can go through your situation, your goals, and what your realistic options are moving forward. If you found this video helpful, make sure to subscribe for more content around property, lending, and investing. Thank you for watching, and I'll see you in the next one.